Welcome to the deep dive. If you're thinking about retirement, well, you're probably feeling a mix of things, right? Excitement, maybe a little bit of worry.
It's understandable. That old picture of retirement.
Hmm.
Comfy pensions, solid Social Security, banks actually paying decent interest.
Yeah, that picture feels, well, a bit faded for many people now, almost like a historical photo.
Exactly. And the cost of living keeps climbing like this hungry little monster.
So our retirement plans, they need more than just hope these days. They need, well, some serious backup.
That's really the heart of the issue. The old ways often just don't cut it for generating the income people need later on.
Which brings us perfectly to today's topic. We're diving into something our source material flags as maybe underappreciated. Greystone Housing Impact Investors LP, ticker GHI.
Right, GHI on the NYSE. And the headline number that jumps out is the yield, potentially around 10%.
Now hold on, 10%. That immediately makes you think, what's the catch? Is this legit?
And that's a fair question. But no, according to Tony Hicks's blog post, this source we're drawing from this isn't some, risky gamble. It's described as a legitimate income-focused setup.
Okay. So Hicks calls it something like collect 10% yields to revolutionize your retirement. Strong title.
It is. And he argues GHI combines stability, a social mission, and that cash flow people are looking for.
So our goal here today is to really unpack that. Could GHI genuinely shift your retirement outlook from, say, worrying about every penny to having more financial breathing room, more dignity even?
That's the plan. We'll look at what it is, how it works, and why it might be worth considering for your portfolio.
All right, let's start at square one. What is Greystone Housing Impact Investors? It's not your standard REIT, right?
Correct. The structure is different. It's a limited partnership, an LP. But its behavior, very much like an income-focused real estate trust that's also mission-driven.
Our source described it almost like a mashup.
Yeah, that's a good way to put it. Kind of the love child of a municipal bond fund and a real estate income strategy.
With some ESG flavor sprinkled on top.
Exactly. A definite ESG component. Its main business is investing in mortgage revenue bonds, both tax-exempt and taxable ones.
And these bonds fund what specifically?
They fund affordable housing projects primarily, but also sustainable infrastructure. Think low-income apartments, schools, hospitals, things communities really need.
So your money is actually doing something. Well, something constructive.
That's a big part of the appeal mentioned. You're potentially getting a solid return and contributing to something positive.
Okay, that dual benefit is interesting. High yield, plus feeling decent about where the money's going. Let's dig into why this matters for an investor, beyond just the feel-good part.
Well, first, those tax-exempt revenue streams. A good chunk of Greystone's portfolio comes from municipal bonds, specifically those mortgage revenue bonds.
And many of those are federally tax-exempt.
That's right, which means for the investor, you get that potentially high yield with less of a tax hit. You might keep more of it.
Okay, high yield, lower tax drag. That's a powerful combo. And the social responsibility side. Sometimes ESG feels a bit vague.
It can feel that way sometimes, yeah. But here, the source argues GHI really walks the walk. They are directly funding housing for communities that need it.
So it's tangible. You know your investment isn't tied to something like, I don't know, leveling a rainforest.
Exactly. It offers a certain peace of mind, as the article puts it, and about that yield.
The 10% number. Is it consistent?
The source emphasizes it's not just a one-off teaser. GHI has a history of consistent quarterly distributions that really make things like T-bills, bank CDs, or even mini corporate dividends look, well, pretty small in comparison.
Okay, so we know the structure, the mission, the potential benefits. Let's open up the hood now. What's actually in this portfolio generating that income?
Right. The biggest piece, nearly 80%, is those mortgage revenue bonds, or MRBs.
The ones financing affordable multifamily housing?
Precisely. And key things about them. Often tax-exempt, usually backed by government or quasi-government agencies, and secured by the actual real estate.
So collateralized by property, they might sound a bit boring on the surface.
Maybe boring compared to tech stocks, sure. But the source frames them as boringly lucrative, reliable income generators.
Makes sense. What else is in there besides the MRBs?
They also hold what are called governmental issuer loans. These can be taxable or tax-exempt.
And who are they loaning to?
State housing authorities, other public bodies. It's basically GHI providing capital for essential projects, schools, hospitals, senior housing, and then they collect the interest.
So like a lender, but for community infrastructure.
You could sort of think of it that way, yeah, like a strategic lender with a social conscience, maybe.
Okay. And do they own any actual buildings themselves direct?
They do hold some direct ownership stakes in a few multifamily properties. It's a smaller part of the portfolio, though.
And these aren't luxury condos in prime locations, I assume.
No, definitely not trophy assets. They're described as strategically chosen income properties, specifically serving underserved markets.
Which means lower default risk, probably higher demand.
That's the idea. Low default risk and high consistent demand for that type of housing.
So it's this mix, mostly bonds secured by affordable housing, some loans for public projects, a few properties that generates the income.
Which leads to the stability question. 10% yields usually screen risk.
Right. The source uses a great analogy. The typical 10% yielder is like dating someone with a Harley, a history of bankruptcies, and a whole mixtape of red flags.
Okay, I get the picture. But GHI's yield is described as surprisingly chill.
Exactly. And the reason for that relative stability comes back to those revenue bonds being tied so closely to government-backed affordable housing.
How does that backing work? What kind of support are we talking about?
It's layered. You've got the federal low-income housing tax credits, LIHTCs, which are huge for financing these projects.
Yeah. Then you often have state grants involved. And very importantly, Section 8 tenant support, rent subsidies.
So the government support helps ensure the tenants can actually pay the rent.
Precisely. Which means the rent checks are much more likely to keep coming in consistently.
So the risk of default on those underlying properties is significantly lower than, say, a purely market rate apartment building in a downturn, or my cousin's crypto portfolio, as the source jokes.
Much lower, generally speaking. That government support system provides a real cushion.
Okay, that makes a lot of sense. So beyond the stability, what else makes Greystone unique? Because this whole setup, an LP doing affordable housing bonds, isn't something most investors see every day.
Well, one really standout point is the consistency of those quarterly distributions. We touched on it, but the source emphasizes they've been paying out quarterly reliably for a very long time, since the first Bush administration, apparently.
Wow, okay, so stability and even gradual growth in those payouts over decades?
Yeah. And the current annualized payout, around $1.52 per share lately, gives you that 10% yield at recent price levels, roughly $15 a share.
That's a serious track record. What else?
Another key point highlighted is the move they made back in 2022. They brought their management in-house.
Instead of using an external manager. Why is that a big deal?
It's seen as a really savvy move. It generally means lower operating costs. Management's interests are better aligned with the shareholders, the investors, and they just have tighter control over operations.
Did the market react much?
The source says Wall Street basically yawned. But for income investors, they see the long-term value in lower fees and better alignment. They know better.
Right. And what about leverage? Debt. High yields often involve lots of borrowing.
GHI does use leverage, yes. But the description is that it's modest and strategic.
So they're not maxing out the credit cards on risky flips.
Definitely not. They're using debt carefully to build that stable income portfolio. It's about income stability, not creating drama.
Got it. And this loops back nicely to that ESG angle, the social impact. It's not just about the money.
Exactly. It's worth pausing on that. The source makes the point that investing here isn't just about, stacking cash. You're actually funding affordable places for families and seniors to live.
And supporting schools, hospitals, and places that need them.
Right. Backing these long-term, sustainable projects that might otherwise find it hard to get funding, it's investing and contributing.
The source even suggests you could tell your grandkids, yeah, I helped fund low-income housing and made 10% doing it. Kind of an ethical flex.
An ethical flex activated, I think was the phrase. It's a compelling combination for sure.
Okay, but let's be realistic. Nothing yielding 10% is completely risk-free. It's not a savings account. What are the potential downsides investors need to be aware of?
Absolutely critical point. The risks are there, though the source argues they're manageable and pretty clear. First up, interest rate sensitivity.
Right. Bonds, especially longer-term ones like mortgage revenue bonds, typically drop in value when rates go up.
They don't exactly love rising rates, no. Their market value can dip. But, this is key for GHI, their focus is income.
So as long as the interest keeps flowing from those bonds.
They're less concerned about the daily or monthly mark-to-market price swings. It's about the cash flow stability for their distributions.
Okay, so the income stream is the priority over the bond's fluctuating price. What other risks?
Regulatory risk. Affordable housing is often caught up in politics. It can be a bit of a political football.
Changes in government funding programs or housing regulations could impact things.
Potentially, yeah. It could shrink the pipeline for new projects down the line. But again, GHI's strength is in its existing portfolio of income-producing bonds. They aren't entirely dependent on a constant flow of brand new deals.
Got it. And what about actually buying and selling GHI? Liquidity.
That's another point. It's a smaller company under $400 million market cap, making it a microcap.
So not like trading Apple or Microsoft.
Definitely not. You won't find huge daily trading volume or active options markets. You probably won't be day trading this on Robinhood.
But for a long-term income investor.
For someone looking to buy and hold for the income stream, that lower liquidity is usually much less of a concern.
Okay, let's put that 10% yield in perspective again. How does it really compare to other things investors might own?
The force gives some useful benchmarks. Think about a broad bond fund like Vanguard Total Bond Market, maybe yielding 1.6%.
Tiny, relatively speaking.
Yeah. Or the S&P 500 index via SPY, around 1.3%. Big tech names like Apple or Microsoft, even lower, 0.5%, 0.7%.
Okay. What about traditional dividend stocks?
Well, Coca-Cola might be around 3%, Verizon maybe 6.5% recently, ExxonMobil perhaps 3.8%. GHI's 10% really does sit in its own sort of weird but wonderful corner, as the article puts it.
It really stands out, almost like getting paid double to invest in something akin to Habitat for Humanity, but through bonds.
That's a pretty good analogy for the feel of it. Now let's talk impact.
Yeah.
What does 10% actually do for someone's finances?
Let's run the numbers. Say $100,000 invested.
Okay, at 10%, that's $10,000 a year in income.
Which breaks down to $2,500 a quarter, or about $833 a month.
Right. And the source frames that as a serious boost, like a full-on extra Social Security check, basically, but totally independent of government decisions or politics.
That's significant supplemental income. And if you don't need the cash right away, reinvesting those dividends.
That's where the compounding magic happens. That $100, reinvesting the 10% dividends.
Year one, it's maybe $110,000?
Roughly, yeah. After 5 years, you're looking at something like $161,000. And stretch it out to 10 years.
Could be around $259,000.
Exactly. The source calls it not mad for lazy money. It just sits there and compounds through those high yields.
Okay, this all sounds very compelling, especially for certain goals. So who should be looking at Greystone? It's clearly not for everyone.
No, definitely targeted. The source suggests it's ideal for people maybe nearing retirement who need that stable income.
Or folks already retired, wanting income without selling off assets.
Precisely. Avoiding cannibalizing your principal. Also, conservative dividend investors who like the ESG angle. Or maybe someone just wanting to diversify away from a portfolio that's super heavy on tech or growth stocks.
Who is it not for?
Explicitly mentioned. Probably not the best fit for, say, a 22-year-old momentum trader looking for quick capital gains on TikTok. It's a different kind of investment.
Okay. And if it does seem like a fit, how do you buy it?
Simple enough. It trades on the NYSE like any other stock. You buy it in your regular brokerage account.
But there's that tax thing we mentioned, the LP structure.
Right, the important caveat. Because it's a limited partnership, you don't get the usual 1099 form at tax time. You get a Schedule K-1.
Which usually means more paperwork, potentially more complex tax filing.
It can, yeah. And there's a specific issue with holding LPs like GHI in tax-advantaged accounts, like an IRA or 401k.
Why is that?
It relates to something called UBTI, Unrelated Business Taxable Income. It can trigger taxes inside the IRA, which kind of defeats the purpose of the tax-advantaged account for that portion of income.
So the general advice is often
to hold LPs like GHI in a regular taxable brokerage account to avoid those UBTI headaches. But definitely, as the source advises, ask your CPA or at least do some sober Googling on K1s and UBTI before you invest.
Sound advice. Okay, so let's wrap this up. We've taken a really close look at Greystone Housing Impact Investors. It seems like this potentially magical investment that kind of breaks the usual rules.
Yeah, it pulls together several threads. That stable government-backed cash flow, the potential tax advantages on some of the income, real ESG credibility.
And of course, that headline 10% yield that got our attention in the first place.
It's certainly not perfect, as we discussed with the risks, interest rates, regulations, liquidity, and it's not flashy or exciting in the way some stocks are.
But the overall picture painted by our source is one of a reliable income-generating machine. A beast, even. Something that could genuinely upgrade your retirement from feeling stressed to feeling more, well, chilled out.
Yeah, if you're tired of growth stocks giving you indigestion and bonds paying practically nothing, maybe adding a bit of Greystone could be part of your own retirement revolution.
It leaves you with a powerful thought. Those 10% yields, they aren't just abstract numbers on a page. They could represent actual freedom. Financial breathing room, definitely something to consider.